Hedge funds, they sound mysterious, powerful, and exclusive. You've probably heard about billion-dollar funds making crazy bets, short selling stocks, or managing the fortunes of the ultra-rich. But how do they actually work? What separates a hedge fund from a regular investment fund? And most importantly, how do they make so much money? Well, in today's video, I'm going to explain that as part of my series, Wall Street Simplified, where I break down all of the fundamentals of finance. And if this is your first time on my channel, then hi, my name is Cameron Galbraith, and I'm a finance professional based here in New York City. I make videos just like this every week, so make sure to subscribe so you don't miss an upload. And now, let's get into the video. Okay, so a hedge fund is an investment vehicle designed to generate high returns for wealthy investors. Unlike mutual funds or ETFs, which are highly regulated and available to the public, hedge funds are private, loosely regulated, and only open to accredited investors, meaning people with a net worth over $1 million or annual incomes over $200,000. Because they cater to the ultra-rich and institutional investors, they have far more flexibility in their investment strategies. Unlike traditional funds, which focus on long-term stock market growth, hedge funds can bet on stocks going up, stocks going down, currencies, commodities, real estate, and even other hedge funds. Their name, hedge fund, comes from their original purpose, hedging risks by investing in both directions, long and short. Today, they do much more than just hedge. They aggressively chase high returns using sophisticated strategies. Hedge funds use the 2 and 20 model, similar to private equity firms. They charge a 2% management fee on all assets under management and take 20% of any profits that they generate. This means that even if they perform mediocrely, they still collect huge fees. For example, if a hedge fund manages $10 billion, they make $200 million per year just from fees, even if they don't make a single dollar in profit. But if they generate $1 billion in investment gains, they take 20% or $200 million in performance fees. Hedge funds don't just buy and hold stocks, they use aggressive high-risk strategies. Here are some of the most popular ones. First is long-short equity, betting both ways. One of the most classic hedge fund strategies is going long on stocks they expect to rise and shorting stocks they expect to fall. A great example is the legendary George Soros, who, however you may feel about him, he made $1 billion in a single day by shorting the British pound in 1992. His fund, the Quantum Fund, placed a massive bet that the British currency was overvalued, and when it crashed, they made one of the most profitable trades in history. Number 2 is global macro, so betting on big economic trends. Global macro funds make bets based on interest rates, inflation, and global events. One of the most famous hedge funds, Bridgewater Associates, run by billionaire Ray Dalio, uses this strategy. Bridgewater correctly predicted the 2008 financial crisis and made billions for its investors by shorting the stock market before the crash. As I'm sure you all know, life in New York City can be expensive. So much so that earlier this year, I tried cutting back on my daily trips to the coffee shops to save money. Well, that was not fun at all. It turns out this is a luxury that I do not want to sacrifice. But fortunately, I found out about Mint Mobile, who is actually the partner of today's video. Mint Mobile offers premium wireless for just $15 a month, and you can get high-speed data and unlimited talk and text on the nation's largest 5G network. You may not know this, but I actually record all of my content from my phone, so it was really important for me to be able to keep my phone and my number, and fortunately, Mint Mobile lets you bring your existing device and phone number onto their service, which makes it super simple to switch. And take it from someone who is constantly watching YouTube podcasts and streaming sporting events while on the go, Mint Mobile's wireless service is lightning fast and actually works better in more areas than my last provider. So if you want to save some money without the sacrifice, go to trymintmobile.com/Galbraith or check out the link in the description to get a premium wireless plan starting at $15 a month when you purchase a 3-month plan. And now, for a limited time, you can actually get $60 off Mint Mobile's 12-month unlimited plan. This offer won't last long, so lock in a year of unlimited service today on the nation's largest 5G network for just $25 a month. Thanks again to Mint Mobile for partnering with me here, and now let's get back to the video. Number 3 is activist investing, forcing change in companies. Some hedge funds buy large stakes in companies just to change how they're run. Carl Icahn, a legendary activist investor, took a stake in Apple in 2013 and pressured the company to increase stock buybacks, boosting Apple's share price and earning Icahn billions. Number 4 is distressed debt, so buying companies in trouble. Hedge funds love distressed assets, companies that are in financial trouble but could recover. Firms like Elliott Management specialize in buying the debt of struggling companies, pushing for restructuring, and then making a profit when the company rebounds. They famously bought Argentina's distressed government bonds at a discount and later forced the country to pay them back at full value, making billions. Hedge funds have a reputation for taking huge risks, influencing markets, and even causing financial crises. In 1998, Long-Term Capital Management, LTCM, a hedge fund run by Nobel Prize winning economists, used massive amounts of debt to bet on market stability. When Russia defaulted on its debt, LTCM lost $4 billion in a month, nearly collapsing the global financial system. The US government had to step in and bail them out to prevent a massive meltdown. More recently, hedge funds were at the center of the GameStop short squeeze back in 2021. Funds like Melvin Capital had heavily shorted GameStop stock, expecting its price to drop. But retail investors on Reddit's Wall Street Bets pushed the price up over 1,700%, forcing hedge funds to cover their shorts and lose billions in the process. So all in all, hedge funds are one of the most powerful forces in global finance, moving trillions of dollars and making massive bets on everything from stocks to entire countries. They have the potential to generate insane returns, but are also highly risky and exclusive. At their best, hedge funds identify market inefficiencies, provide liquidity, and generate massive profits for investors. But at their worst, they cause financial crashes, manipulate markets, and profit at the expenses of regular investors. Love them or hate them, hedge funds aren't going anywhere anytime soon. Hedge funds are a core part of Wall Street, and now you know exactly how they work. And if you enjoyed this video, please make sure to like and subscribe because I post videos just like this every week aimed at helping you level up in your career. As always, thank you so much for watching. I'll see you in the next one. Peace.